The global economy just absorbed its fourth massive supply shock in 5 years.
Oil is surging past $130 a barrel.
Inflation is deeply embedded, the S&P 500 is masking extreme concentration risk, and the Federal Reserve, they are completely trapped.
With Chairman Powell staring down this rising wage inflation, honestly, if you are holding a standard 60-40 portfolio right now, your wealth is basically standing on the tracks.
We're looking at a severe physical choke point crisis here. This has effectively ripped up to 15 million barrels a day of crude and refined products right out of the market. The Strait of Hormuz is blocked. That means 20% of the entire world's oil trade has been disrupted, practically overnight.
And you've got to compound that with the breaking news that's sending absolute shockwaves through the energy sector. The United Arab Emirates has officially fractured the 65-year OPEC alliance. Just incredible.
And as the fiat system bends under the weight of all this volatility, central bank vaults are throwing their doors wide open, with gold marching aggressively to $3,000 an ounce.
Quick note, this explainer is for informational and educational purposes only and does not constitute financial, investment, or legal advice. Always conduct your own due diligence before making any investment decisions. All right, Section 1, the global supply shock, a historic energy crisis.
Notice how incredibly fast this escalation happened. Back in late February 2026, geopolitical conflict in the Middle East, specifically Operation Epic Fury, sparks immediate retaliation. Then by March, this triggers the effective closure of the Strait of Hormuz. And by April, the dominoes are falling hard, right? We're seeing cascading force majeure declarations from major producers like Iraq and Kuwait. We went from a relatively stable baseline to what the IEA is literally calling the largest oil supply shock on record. So we aren't just talking about elevated prices here. We're talking about a physical infrastructure crisis that is rewriting global economic models for 2026, pushing heightened risks of stagflation across developing and developed nations alike.
Which brings us to Section 2, UAE shatters OPEC, the May 2026 withdrawal.
Okay, let's dive into this because the mathematical rationale behind Abu Dhabi's decision is absolutely fascinating, and it shows that cartel loyalty only goes so far. So historically, the UAE was capped at roughly 3 million barrels per day under OPEC compliance, even though their actual capacity was pushing 5 million. That gap? That represents nearly 2 million barrels of unutilized capacity, or roughly $46 to $58 billion in foregone revenue every single year. In a world that's rapidly accelerating toward electrification, the UAE realized something crucial. Keeping cheap, high-quality crude in the ground isn't preserving wealth anymore, it's a massive future risk. So this exit allows Abu Dhabi to aggressively monetize its reserves, prioritizing market flexibility and their own independent strategy over cartel discipline. It's a real game changer that fundamentally shatters the decades-old price management architecture of the Middle East.
Now, Section 3, China's exported deflation crisis.
And this brilliantly illustrates what's going on. Because while the West battles inflation, we need to shift our focus east. China has been dealing with a massive property sector collapse and incredibly weak domestic demand. And this has created a phenomenon known as involution. Driven by heavy state investment, they've built up massive industrial overcapacity. But since domestic consumers aren't buying, Chinese firms are engaged in brutal, aggressive global price cutting just to find buyers abroad. They're effectively exporting their deflation to their trading partners, flooding global markets with cheap goods and absolutely destroying competitor margins worldwide.
The mainstream financial media isn't telling you how this impending global trade war will drain your portfolio. Hit subscribe right now to get our raw, unfiltered macro data before the institutional market prices it in. Moving on to Section 4, the central bank gold rush, Fiat debasement.
So as Western nations combat energy shocks and Chinese tariffs, fiat currencies are getting stretched to their absolute limits. Just take a look at these institutional targets for 2026. We've got Goldman Sachs looking at $5,400 an ounce, and JP Morgan projecting a push toward $5,000, and potentially even $6,000 longer term. And guys, these are not speculative guesses. They are mathematical projections. Central banks globally are acting as the ultimate marginal buyers right now. They're reacting to all this geopolitical fragmentation by hoarding massive physical reserves. Get this, they're projected to purchase 755 tons this year. That means they are absorbing a full 25% of annual global mine supply before a single ounce even reaches industrial users or private investors. It is creating a profound structural supply deficit that mathematically forces prices higher.
Let's move to Section 5,
the electric stack squeeze, and see how this all builds up. We call this the electric stack squeeze. The physical realities of the conductive revolution are colliding head-on with extreme extraction limits. Silver isn't just gold's quieter cousin anymore, right? It's seeing surging industrial demand driven by AI data centers, the continued rollout of electric vehicles, and massive solar panel substitution. All of this is pushing global physical investment up by 20%. Meanwhile, copper is facing acute front-end tightness, with analysts projecting prices pushing toward $15,000 a ton. It's pretty simple. You literally cannot build the electrified, automated infrastructure of the future without these metals, and mine supply is completely failing to close the gap.
So are you positioned for the stagflation reality of 2026? The true safe haven for 2026 isn't just holding cash as it inflates away, it's owning the electric stack. Copper, silver, and the physical data centers powering AI. That is exactly where the institutional smart money is hiding from stagflation. To see how to allocate into these specific assets, click the explainer on screen right now breaking down our ultimate 2026 hard asset portfolio. The board is set and the dominoes are falling. The only question is, where will your wealth be when the dust settles?